Let's bring in Jeffrey Sherman, DoubleLine Capital Deputy CIO, and Tom Lee, Fundstrat Global Advisors co-founder. Very good afternoon to you both. Jeff, coming to you in terms of the outlook for rates. Clearly, they got a nice jump post the election. Today, after a closure yesterday, pulling back. Is that a sign that the kind of elusive 1% level on the 10-year is kind of going to be quite far off still for a while?
Well, I think it is, but you have to remember that the bond market was closed yesterday in honor of Veterans Day, so there's a little bit of catch-up that took place. We did have, as Rick said earlier, we had a big bond auction today, the 30-year bond. It did cause a short-term little reversal in yields upward again, but as you mentioned, on stocks been the low, so are yields right now, both 10s and 30s. And so you mentioned the 1% level. I think that is something to really focus on at this point. There's always been the contention in the market that the Fed really wouldn't let the 10-year go above 1%. That maybe they would start to talk more about yield curve control and trying to really rein in at those levels. But if you look at the kind of euphoria you saw in the market and the hopes of the vaccine on Monday, it really skyrocketed rates. And so I think what you see in the rates market, something we've been talking about all over the course of the summer, is that there is the tendency for rates going directionally higher at this point in time. And so when we look across kind of the metrics there, we think fair value is probably in the 1.25, 1.5 range without interference, but it's not going to happen overnight. And so if indeed this vaccine is going to pull through and it's going to get people back out there, we're going to get the economy going again, rates do indeed, or they should go higher at that point in time. So I think what you have is a little bit of, there was a sharp move this week, but we broke out of the range, and that's what you got to look for here. Is that we were mired in this range of Treasury trading from roughly like 55, 60 basis points up to about 80 or so, and we've been out of that range really for the last week or two. You're kind of vacillating around there, but if you draw that line to where we had the highs before earlier in the year, in the course of there was a couple days back in June. Now that's the bottom end of the range right now. So we're looking to see if this is going to be a pivot point to signal rates being higher. But at the end of the day, the Treasury market's going to trade on nominal growth. So at one point, it was fiscal stimulus driving inflation. Now it's the vaccine driving growth. So both of those factors are going to get digested by the bond market, and that's going to determine the direction of interest rates.
Tom Lee, thank you. Jeff Sherman, good to see you as well.